What if I told you buying a stock and buying a player in the IPL auction work in surprisingly similar ways? Think about how the IPL auction works. Every player walks in with a base price, a floor, a minimum price set in advance that nobody can bid below. Then the franchises go at it. The one willing to pay the most gets the player. Two teams want the same guy. They bid each other up until one of them gives up. And the moment the hammer falls and it's sold, that's it. The deal is done. But here's the thing. Each of those ideas, the minimum price, the highest bidder winning, competition pushing the prices up, and the deal becoming final the instant it's struck, is also how stock market works. When you buy a share, you're essentially standing at an auction. You just don't see the others in the room. There's one difference though, and a fundamental one. Unlike the IPL where only buyers compete for players, in the stock market both buyers and sellers compete for a given share. And that interaction is continuous. So in a way, millions of little auctions happen every second the market is open. I'm Sandeep Rao, and that's what I want to get to today. That is, how does this auction work specifically in the stock markets? What happens when you place a limit buy or sell order or a market order? How does it move the price of a stock? In all of this, there is the term order flow which gets thrown around. What does it even mean? Some even claim to trade off it. And more importantly, as a trader or an investor, why should you even know any of this? So without further ado, let's get started. Let's start with the absolute basics. We're trying to understand what an auction actually means. Take this example. Say you are a seller. You have one share of a company called X. You bought it at 90 and today you want to sell it at 100. Now, if you want to sell it at 100, there has to be a buyer willing to pay 100, right? Which means for any trade to happen, you need a buyer and a seller. That's exactly why it's called a two-sided auction. Now, let's extend that. Say you want to sell at 100, but the buyer isn't willing to pay more than 95. In market terms, the ask price, what the seller wants, is 100. You will see this under offer price on Kite. On the other hand, the bid price, that is the max price at which a buyer wants to buy, is 95. This shows up as bid on Kite. For this trade to go through, and let's keep it at one share for now, I don't want to complicate things with quantity just yet, one of the two things has to give. Either you, the seller, has to drop your expected price a bit, or the buyer has to raise theirs. Until you both agree on a number, that trade cannot get through. Now let's say you agree to sell at 98 and the buyer also ups the price to 98. This number, 98, in our case, is the price at which the trade gets executed. Are we good so far? At this point, I want to introduce the idea of bid-ask spread. Remember, the seller wanted 100, so the ask or the offer price is 100, and the buyer only is willing to pay 95, so the bid price is 95. That gap, 100 minus 95, is the bid-ask spread. Here, it's 5. So now we know three things. What is a bid? What is an ask? And what a bid-ask spread is. Let's move further. Now let's assume we have multiple buyers and sellers at different price points. To keep things simple, I'll take a small example. Two sellers and one buyer. Two sellers, one offering at 100 and one at 105. In terms of quantity, there's one share available at 100 and two shares available at 105. And there's a single buyer bidding at 95, wanting two shares. So we've got one bid and two offers sitting there. Each of these is a limit order because everyone has specified their limit. The buyer is saying, I'll buy only at 95, not a rupee more. The sellers are saying, we'll sell at 100 or 105, not a rupee less. These are also called resting orders or sitting orders because they sit in the limit order book until a match happens. Now think of the limit order book as a dynamic ledger at the exchange where the bids and offers keep arriving and get stacked based on their price. Back to the bid-ask spread. The best bid is 95 and the best offer is 100, so again the bid-ask spread is at 5. And nothing has matched yet because until a buyer and a seller land on the same price, no trade goes through. I'll take two scenarios over here. Scenario 1, same as before, somebody updates their price. Let's say the seller who was offering at 105 gets a little impatient and lowers the offer to 98. Essentially, they've dropped their expectations. And notice it's still a limit order. We just now have two limit orders on the offer side, 98 and 100. And the buyer is still bidding at 95. Now let's say the seller drops it further to 97. Two shares sitting there at 97 and the buyer who wanted it raises their bid to 97 and takes it. So two shares exchange hands at 97. That's the trade. Notice how it happened. The seller posted 97 and waited, and the buyer reached across and accepted it. That's broadly how limit orders work. But there's another possibility. What if the buyer badly wanted those shares and didn't care about the exact price but just wanted in? Remember the two offers that were sitting at 100, one share, and 105, two shares? And the buyer wanted two shares in this scenario. So the buyer could skip the waiting entirely and place a market order. So let's see what happens then. With a market order, the buyer is essentially saying, I'll take it at whatever the available price, just get me in. So the market order looks for the lowest offer, that's one share at 100, done. The buyer gets that. The buyer wanted two. So the market goes to the next best offer at 105 and the buyer gets the second share there at 105. So eventually the buyer walks away with two shares, one at 100 and one at 105 at an average cost of 102.5. That's a market order. It's a bit like handing over a blank check and getting it done at whatever price it takes. So now we know quite a bit. We know what a bid is, what an ask or an offer is, and what the bid-ask spread is. And we know what a market order and a limit order are and how they work inside the limit order book. There's one thing worth noticing. When you look at the market depth on your screen, you don't actually see market orders. What you see are the resting limit orders, the ones sitting and waiting. The market orders barely appear at all. They happen in a flash. They come in, they take the liquidity that's resting there and they're gone. There's nothing left to display because a market order doesn't sit somewhere. It just consumes liquidity. And that's exactly why market order is set to take liquidity and a limit order is set to provide it. Now, if you've traded stocks, especially mid and small caps or micro caps, you've seen some of them hit what's called a circuit. It could be an upper circuit when there's a flood of buying pressure, or it could be a lower circuit when there's a lot of selling pressure. What actually happens in a circuit is that one side of the book goes completely lopsided. Take upper circuit. There are no sellers left, only buyers. If you pull up the market depth, you will see bid after bid stacked up. Plenty of people wanting to buy, but the offer side is completely empty. Nobody willing to sell. The lower circuit is the mirror opposite. Offers stacked up, everyone trying to sell and no bids. No one is willing to buy. And that's why the price gets stuck. With buyers but no sellers, or sellers but no buyers, there's simply no one on the other side to trade with. A trade needs both, remember. One side alone can't make it happen. But there's a second reason it gets stuck, and this is where the exchange steps in. You see, the exchange sets limits on how far the price can move in a single day. Once the price hits that level, it can't go further, it sits there frozen. Let's take an example. Let's say a stock has a 5% circuit limit and yesterday it closed at 100. That 5% sets the band for today. The price can only go as high as 105 or fall as low as 95. Now imagine great news breaks about the company. Everyone wants it. Buyers keep bidding the price up 101, 102, 103 until it reaches 105, the ceiling. And here's the catch. At 105, the buyers are still coming in, but no seller is willing to let go because everyone's convinced it's going to go higher. So what you've got is a wall of bids at 105 and not a single offer. There's nobody to sell to the buyers. The stock is locked in a upper circuit. You want to buy, but you simply can't because no trade can happen without a seller. Now this can continue for days together with price jumping each day but locked in a circuit. No trades happen but the price keeps moving. The lower circuit works exactly the same way in reverse. The price falls to 95, the floor, and it stops for the day. This too can continue for days together. With each day, the price goes lower without any buyers. A circuit, in a way, is just the most extreme version of everything we've been talking about. All along, we've said a trade needs two sides, a buyer and a seller meeting at a price point. A circuit is what happens when one of the sides simply vanishes. While the auction is still running, just that it has become one-sided for the time being. And yes, do note the circuit works a bit different for F&O segment stocks, but we'll keep that for later. I keep mentioning this limit order book term, the ledger where all the resting orders sit and wait. Let's actually open it up because you most certainly seen it live and possibly you may have wondered what you were looking at. In Kite, when you tap on a stock and pull up market depth, that panel is the order book. The first thing you'll notice is that it's split down the middle. On the left, the bid side, every buyer and the price they are willing to pay. On the right, the offer side, every seller and the price at which they want to sell. This, in a way, is the two-sided auction I've been describing, just laid out on a screen. And notice each side is sorted by price. On the bid side, the highest bid sits right at the top. Say your company X has the best bid of 98. On the offer side, the lowest offer sits at the top, say 98.05. So in a way, the best buyer and the best seller end up staring at each other across the middle, and the little gap between them, the 5 paise here, is the spread. By the way, in a liquid stock, the spread is tiny, just a few paise, not the big 5 rupee gaps we used earlier in the example, just to keep the math simple. And the smallest possible move, the 5 paise, isn't random either. The exchange defines the minimum amount a price can move, and that's called the tick size. A stock can't move by less than 1 tick. I've actually done a video on what a tick size is, you may want to watch it. Okay, let's get back to the order book. Now look at the columns. Next to each price, you've got two numbers, orders and quantity. Quantity is the easy one. It's the total number of shares people want to trade at that price. So at 98, maybe there are 100 shares being bid for. But the orders column is an interesting one. Those 100 shares aren't always or aren't necessarily just one person. It might actually be 12 different people, 12 separate orders all bidding at 98, and that happens to add up to 100 shares. And that number 12 is telling you how many people are standing in the queue at that exact price. The rule that runs the order book is called price time priority. Two fundamental ideas in that order. Let's start with price. The best price goes to the front. Let's say you bid 98 when everyone else is at 97.95, you get served first. But when 12 people are all bidding at the same 98 price level, then time comes in. First come, first served, that's the logic. Whoever placed their order earliest sits in the front of the queue, and whoever showed up the last is at the back. Now, you actually can't see that on your screen as to who joined the queue and when. And there's a reason for that, which we'll get to in part 2. For now, just hold on to this. What you're seeing in market depth is aggregate information, 12 orders, 100 shares, not the order by order detail underneath it. So far, we've talked about all the basic concepts related to orders and the limit order book. But there's one key aspect we need to understand, and that's the idea of an aggressor. Because without that, nothing moves. Literally nothing moves. So we've got this limit order book full of orders all waiting. Buyers stacked up on one side, sellers on the other side, and nothing will happen. Because waiting doesn't make a trade. For anything to actually happen, somebody has to stop waiting and make the move. Somebody has to look at the best offer sitting there, say at 98.05, and say, fine, I'll take it. Someone has to cross the gap and grab what's resting there. That person or order is called the aggressor. They are reaching across the spread and taking the resting orders. Now connect this to something we said earlier. Remember, I said a limit order provides liquidity. It sits there offering. A market order takes it. Well, the aggressor is the taker. When you place a market order, that is, get me in now at whatever price available, you are being the aggressor. You cross the spread, you hit the best resting order, and the trade happens. Instantly, you made it happen. You can activate that aggression through limit orders as well by updating limit orders to close the spread. It's called a marketable limit order. So in other words, an aggressor is simply whoever crosses the spread and takes a resting order. Market order or a marketable limit order doesn't matter. What makes you an aggressor isn't the type of order or the side of the book where you sit. It's the fact that you chose not to wait. And that choice to stop waiting and taking the resting orders is the single most important thing that drives the price in any given market. Now, everything we've been describing in this whole episode, the bids arriving, the offers arriving, the market orders coming in and taking the resting orders, that constant stream of orders hitting the market moment after moment is what people mean when they say order flow. It's just that, the flow of orders and everything that goes into the process. So the next time someone uses the term order flow, you know what they mean. So we've understood all the building blocks that go into what everyone calls the order flow. But I want to end where we started, the idea of an auction. Because underneath every single thing we've talked about today, that's all this ever was. You see, the whole process, buyers and sellers coming together, is at its heart exactly that, an auction. The dynamics may shift from moment to moment. Sometimes buying pressure, sometimes selling pressure, sometimes it turns extreme, a wall of buyers with no sellers, and you get a circuit. But whatever the conditions, underneath it all, it's still the same thing, it's still an auction. A two-sided, continuous auction, more dynamic than the IPL auction and far more complex in how it works. And that's really what an exchange is for. The exchange and all the rules that govern it exist to do one job: to make that auction as fair and as orderly as it can possibly be. So that's the foundation, order flow and the auction underneath it. In part 2, we'll take this further. Because knowing all this is one thing, seeing it is another. And remember, the exchange or your broker, any broker for that matter, doesn't show you everything. What we as retail traders or investors get to see on our screen, be it in the market depth window or through order flow charts, it's only a slice of the real picture. And in the next part, I'll explain exactly how much of it we are actually seeing and how much of it is hidden from us. I hope you found this episode useful. If you have any questions, feel free to drop them in the comments. I'll be happy to respond. And don't forget to subscribe if you haven't so far. Till then, take care and trade safe. I'll be back soon with the next one.